My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is returning champion, Jeffrey Hirsch. Jeff, I know we've done this a number of times here, but just for those not familiar with your background, as always, introduce yourself. Who are you? How'd you get involved in markets? And can you tell me if we're in a correction now or not?
I am chuckling. The returning champion comment. Always away with words there, Michael. Well, my name is Jeffrey Hirsch. I am the editor-in-chief of the Stock Traders Almanac, and I got into this business with the Almanac. I was born, bred, weaned, raised on it. My late father, Yale Hirsch, started it back in 1966, and we've been publishing it ever since. The first edition was the 68. It came out in the fall of 67. We have an associated newsletter at stocktradersalmanac.com where we basically put the almanac to work and recommend stocks and ETFs and, calendar strategies and general market outlook and looking at all sorts of things, not just seasonals and cycles and patterns, but fundamentals and technicals and monetary policy and geopolitics and the news flow. And we try to just look at the market as the real thing that it is. And that's kind of how I got here. I started with him full-time back in 1990 and took over around 2000. And we've been at this for several decades. And we are currently working on the 2024 edition, as well as an edition of the Commodity Traders Almanac, which we haven't put out since 2024. And that's going to come out. We're going to self-publish that. Should be out in September or so, maybe October. Putting together that data, working with printers again. And, right now we're looking at, a sideways range-bound market. You want to call it a correction? Sure. I'm looking for lots of chop and volatility. We've got several things converging, seasonal headwinds, fundamentals, technicals. As I said, monetary issues, even though it looks like the Fed's about to pause. Geopolitics and politics, and of course, what the news story that Michael mentioned will be distracting the airwaves as well. But there's also support. There's also positives, and it really lines up well with our strategy, our cycles, our patterns, the seasonals, the 4-year cycle. I know it's a pre-election year, but the worst 6 months, the sell and May period, the May through October period, pretty much gains about 1% or so. And bounces around a lot. And then there's the debt ceiling, which I put out a chart on recently, a nice analog to 2011. But, we're using this time between, NASDAQ has the best 8 months. It goes to June. And the time between when we got our MACD sell signal for the best 6 months ending in April 25th until we get a sell signal for NASDAQ, we sort of transition to neutral. I've unloaded some things. We've tightened up stops. We picked up some bond positions, and we get ready for the summer and get ready for that fatter pitch later in October. I'm looking at this chart right now of 2011 versus 2023, and I don't know, that August to October period, or early October, it looks like a pretty good buy point if it tracks like it continues to track like it is. But the thing that's going on. Was there any news today with McCarthy and Biden? They didn't meet yet, did they?
I have been on calls all day long, so I don't have a clue. I think they are meeting. I think currently I'm seeing on the CNBC. I'm like,
currently or around this time. The thing that's interesting, and we annotated this chart, the events that happened in 2011, and these moves, like especially the speech that McCarthy made to Wall Street, and the demand for cuts, holding that hostage with the debt ceiling. Same first move Boehner made back in 2011. I think Boehner and Obama may have had a more cordial relationship. I don't know if you remember that scene from the White House movie theater where I guess Obama bummed a Marlboro Light off of him or something like that. They were a little more jocular than the current speaker. Same political alignment, Democratic president, Democratic Senate, Republican House, same basic MO and strategy. And it just looks, and of course the calendar of Congress hasn't changed. They're still going to take a recess. They're still going to start campaigning for 2024 in the fall. So they're going to have this battle, whether it ends around the same time or before, or I don't think after, but it promises to be a somewhat similar trend and pattern for the market, and for the battle, for the showdown. So that's one of the big things we're looking at right now. We started talking about it over a month ago before it became front page news or whatever, financial news. So what do you think? What do you want to know about most? I sent you a whole bunch of points,
Oh yeah,
Michael.
no,
I just did a
I'm
data
gonna write
dump.
them off. Hold on, I want to know on a personal level. Do you get frustrated when people automatically say sell in May as if it assumes stocks will go down?
Yes,
I gotta man,
every
gotta
year.
drive you crazy because the research. It's not that stocks go down; it's that they have suboptimal returns.
Yeah, I mean, we have this battle not just with the sell in May, but with the Santa Claus rally and with the January barometer. I mean, I spend my life rebutting rebuts, but I like to try to make light of these things. So everyone gets so focused on whether they should sell in May or not. I said, well, you got to get yourself you got to buy in October, get yourself sober first, which we did. I try to make a rhyme there, but basically the point is that sell in May is meaningless, or at least reposition in May, as we like to do it or say it. It doesn't matter if you haven't gotten long in October, especially when it sets up like this last year. I mean, you remember we were bearish last year. We were out of the way and rode that thing down, midterm bear market, bottom picker's paradise, October bottom, and we put out a buy signal in October. So the cycles are working. They don't always work this well. I mean, back in the late 90s and that period, everything was straight up. There wasn't much of a 4-year seasonal cycle as much. But right now, since the last couple of years, it's been right on point. And over the long history, it has, and long and short histories, whatever time frame you want to look at, except maybe a few select years here or there. But when it tracks like this, as I look at the chart of 2011, 23 late over 2011, it's a positive indication that it's tracking closely to the patterns of the seasonals.
All right. So speaking about tracking and patterns, I mean, I know a lot of the work is obviously around broad averages, but this year I'd argue is odd in the sense that there's a hell of a lot of divergences that are occurring, right? So you got the Nasdaq, which is up really strongly. You got small caps, which basically are, I think they're down last I checked year to date. SP's up roughly, I think, what, 5.5%, 6%. So there's a lot of variability in terms of the performance. It's not like rising tide is lifting all boats. And I saw you like that tweet, that thread I put out that basically shows that 30% of the Nasdaq's above the 200-day moving average. Everyone's seemingly is bulled up. Yes, it's been chopped for the large caps, but there does seem to be like there's a correction underneath the surface. In prior pre-election years, how do different cap indices tend to behave compared to what's happening now? Meaning small caps, mid caps. Is this a bit of an outlier?
Everything's behind. Everything's behind. I mean, the sweet spot that we've spoken about before got a little soured. I mean, Nasdaq's leading, but the 3-quarter combo from the Q4 to midterm year to Q2 of the pre-election year, Nasdaq's up 29% on average. It's nowhere near that. So, this brings me to the debt ceiling showdown and the other issues that are going on here. Yeah, I mean, the seasonals are working, but in conjunction with the other analysis. And it's like a pre-election year that's got other stuff going on. And I think that can push this usual, bullish, big bullish move out a little bit to fourth quarter and even into the election year that have been, getting better recently. But the small caps, they underperform seasonally, starting in March as well. I know it's behind. There's the banking crisis definitely took a toll on that, and the consumer as well is having an impact there. But there are other things going on. I mean, yeah, the economy's slowing, but it's still positive. I mean, GDP now looks like it's going to be positive, but a little bit slower. The Fed hiked rates, but looks like they're pausing. There's a lot of cross currents that, to me, yes, we'll probably get a correction, whatever you want to call that. We had one in March. We'll probably have more, 5-10%, whatever. I mean, 2011 S&P was down 19.4%. That was a mini Ned Davis research defined bear market in my book, and it is in my book. But it's not atypical. It's very much like a lot of years where there are things going on in the economy, in the political arena, in the geopolitical arena. And it's something to expect. That's why the best 6 months, worst 6 months works. We get out of the way of this stuff. This kind of thing tends to happen during this time frame when politicians and companies operate on their calendar basis.
It's interesting to me when I look at consumer discretionary stocks and retailers. I mean, they broadly keep on underperforming. So I've made this point before. Lumber weakness, which is about housing, is consistent with small cap weakness. Weakness consistent with consumer discretionary weakness. So if you believe that there's a leading aspect to markets, the fact that these areas are already weak would suggest that we're entering a weak period. Coinciding with the sell may go away period.
Yeah, it's precisely totally coinciding with it. I mean, we put out the best sectors for the worst months, and it's staples that are up there consistently. Not necessarily mind-blowing gains, but average gains, but up 78.8% of the time from 1990 to 22. Consumer staples, the S&P staples sector, along there with healthcare. I mean, these are the kinds of sectors and the ETFs that we have put out in the newsletter for people to rotate into during this seasonally weak period and fundamentally weak period like you're talking about. So, it's about using all of the data and tools that we have. It's not, I'm a big fan of the CMT. I use technical analysis. I think I sent you a picture or you've seen my charts. I'm actually going to go for my CMT. I got level 1 in, but we also look at fundamentals. First thing my father taught me when analyzing a stock was price to sales ratio. And still look at things like that. We have a fundamental stock screen, a robust screen looking for acceleration of growth and acceleration of growth in revenue and earnings, amongst other things, evaluations, PEs, price to sales, et cetera, and under Wall Street Trader. And then on the short side, we look for the inverse of that. So it's not just about patterns, cycles, seasonality, or fundamentals, or technicals, or monetary policy, or sentiment. It's all of it. We call it the 5 disciplines.
So I was doing a podcast earlier with Stansberry Research, and the question posed to me was, so what about all this speculative short positioning in S&P minis, and shouldn't that result in a floor, right, for equities if we're in a correction or about to have a correction? And my response was, okay, well, the problem with all this thinking around the contrarianism of positioning is that everyone else knows to be contrarian, which means you have to be contrarian on being contrarian, and maybe the next speculative short will be right.
Doesn't that cancel it out?
That's my point. That's exactly my point. So I don't know. Have you looked at any of that kind of data around futures positioning? Does that throw anything off, or is all this independent of whatever position existing large speculators have now?
I look at some of that stuff. I think the options, the old put call ratio out of Barron's, which was the weekly one, was great when they didn't have every kind of option out there. I think some of these contrary indicators, the VIX as well, and put call and the COT report and the kind of stuff that you're talking about isn't quite as indicative as it used to be because everyone's following it and it's just too much going on there. I still look at investors' intelligence sentiment for that. And it's kind of something that hasn't been as manipulated. I know it's a survey, but you're talking about a survey of people like ourselves who actually get paid to tell people what they think the market is going to do and have been doing it for years. So it's a survey of, the smart money, I guess you could say, or at least, not just people with opinions, people that get paid for their opinions. And that seems to work. And it seems to have shown a drop down in October. I could show you that. I've posted it. I have it. But it really, and I go back, 20 some odd years, you can see those peaks, the difference of those peaks or valleys, the difference between bulls and bears really shows up, in 08, 09, in 15, 16, in 11, as I mentioned before, and here in back in 22, in June and October. So you have to look for sentiment indicators that are, or contra indicators that are indicative. So just because everyone's short and everyone knows about it doesn't mean it's necessarily a buy. It's something that you have to take into consideration with other things and look at if it's actually working or has worked. But yeah, big short positions in general probably means there's a put underneath there. Probably keeps a floor in there. As I said, I'm looking at the range for the S&P of 38 to 4,200. And if we break above that, that'll be bullish. If we come below that, that'll be more bearish. Otherwise, I think we're trapped in that range.
Yeah, and it's funny. I had put out that tweet before. It's like everyone's getting hyper bulled up or hyper bared up, and the reality is markets haven't gone anywhere now for a while. On a real return basis, they have, right? But the reality is there hasn't been too much from like a year and a half ago, at least on the S&P. I want to go to the CDS spreads, right, on the US, right, which is, I've been watching this on the periphery. It's this is another parallel to your point around 2011. Has that been surprising to you? Because everyone, look, we all know this shit's going to get passed. It's like
yes.
this is
yeah. Thank you. Yeah, thank you.
But that's not to say that you can't have other unintended consequences of them playing games, like what happened in 2011 with the debt downgrade.
True. I do think we benefit from having been through this in 2011 and being more aware of it. I think that may soften the impact a little bit, or at least, or somewhat. Remains to see how much. But go on with the CDS.
Well, no, but the point is, like, if you would think markets would say, okay, this is not going to matter, so why would the insurance side get bid up? So what's your interpretation of what's happening with the CDS side of things?
They're basically saying that we're in a situation where the government's going to screw around, the politicians are going to screw around and freak the markets out, and we're going to have a situation, somewhat relative to what we had in 2011, where the markets are going to bounce around and correct and be volatile while they figure this out. And if they don't, these people that are making these dire bets are going to make a lot of money. So these are people that know a lot. I mean, these people know math like you wouldn't believe. And, this was something that was brought to our attention recently by a subscriber, which is great. And it's indicative of the correction you're seeing, of the volatility I'm expecting. But it doesn't mean that the world's over. I mean, the other two spikes on that chart, we came back pretty smartly from there shortly thereafter, correct?
So it's funny. I was looking up the link I'm going to share in the Nest, and my tweet copy pretty much explains it. I didn't realize this myself, but so this is 5-year CDS in euros, right? I guess is sort of the way this is priced, right? That chart.
Yeah, it's the people. It's the prop desks overseas, I think, betting against the U.S. perhaps.
Right, and it's above the 2011. Move. You're actually entering like 2008 type or post 2008 GFC type levels. I don't know. That seems like wildly speculative. Or to your point, maybe somebody knows something. You see this idea that's being floated around that maybe they'll just ignore it and say it's not constitutional. But
I don't think you can go back further in the chart. I don't think you got 2008 on there.
Well, I think that spike has probably looked at it from the 5-year. I could be off on that, but I just did it quickly. But yeah, it is interesting. And what's amazing to me is that treasuries are not really responding on this just yet, right? So I remember in 2011, treasuries were kind of creeping higher in price, dropping in terms of the duration, right? You were seeing yields drop on the low end, almost like in anticipation of something coming. You're not seeing that just yet.
To me, it's like I'm saying we've been here before. This happened in 2011. Everyone's aware of it now, and I think these people are overshooting a little bit on the short side with these CDSs, if that's the proper plural, whatever. But again, the bonds aren't responding. Isn't that the market that has the real PhD in economics is the bond market? It just again supports the range situation. You got fear mongering speculators, expecting this thing to implode, but the bond market's kind of just mellowed out. The Fed's slowed down. I want to ask you, what do you think about this QT? You think it's going to end a lot sooner than they think?
I think it's the cleanest way for the Fed to save face, right? So optically, for the average American, hearing the Fed lower rates versus keeping the balance sheet elevated, they probably want optically just to say that they're not lowering rates to fight inflation. Right, I think there's almost like a messaging aspect as far as the QT versus lowering rate type of argument.
Yeah, I don't think they're going to be able to get it down much below 6 or 7 trillion, if that. They're not going to go pre-pandemic. It's impossible. It's too big.
Yeah, and then of course,
and the regional banks.
So that's the other thing too, which I want to hit on, which is I had made that argument on a segment that you've got the speculative shorts on treasuries, right, and you've got this huge hold that the regional banks have because of the duration mismatch. Okay, one way to save, in quotes, the regional banks, I would argue, and maybe it's conspiratorial, is engineer a short squeeze in treasuries to at least fill the hole a bit, meaning treasury prices go up, long duration yields drop, right, to kind of at least give the regional banks some time. You think that's a possibility? I mean, if duration stays where it is, you're going to have a lot more bankruptcies, and it's already affecting credit. The Fed probably wants that, but doesn't want it to get out of control.
Yeah, that's why I think they'll end up having to put money back in and expand or stop decreasing their balance sheet it just doesn't seem like they can continue to let it roll off at the pace that it's at. Maybe for a little while longer, but I don't know. The whole banking thing hasn't blown up though. There's been a couple of scary days. Back in March there was a couple of scary weeks, but it seems to have stabilized. Maybe it's not as bad. I mean, there's so much fear mongering on cable TV and the papers. Everyone's talking about how bad everything's going to be all the time. I mean, that fear sells. We know that, but where's the recession that everyone was warning us about? It's still coming, right?
Right. It's always coming as long as you're wrong, right?
Right. Yeah. I mean, I just don't get it. We thought there was a recession last year when we had the two negative quarters.
So play it out. Let's say, okay, so the Settlement playbook, is there, and then you re-enter the best 6 months. I hear you. It seems like things are a little bit off timing wise because of these other factors, but presumably there's going to be a point where there's such an overreaction in regional banks that it's a tremendous trading buy, maybe not a long-term investment, right? But for you yourself, would you consider, is that like on your watch list? It's like you get kind of excited seeing what's happening with regional banks for a long position?
I don't get excited about regional banks unless they show up on my fundamental screens at the time of year and with the proper technicals. That's when I get excited. When things look really cheap, when the market's been down, like last October, last September, we were getting excited about things. When it all lines up well, that's when I get excited about getting long positions. And, I'm not a guy that takes, long-term positions. I eat my own cooking. I trade the best and worst months. I rotate my sectors. I keep the stocks in my portfolio. If they keep going up, I hang out them. If they come down, we get out. We tighten up stops. We bring up stops, and we trail stops there. We sell half on a double, and that's what I do. I'm not going to say, oh, let's make a position in Apple now for the long haul. That's just not. I mean, I'm not saying that one shouldn't do it, but that's not my it's not my style. It's not my strategy. I'm an almanac trader.
That is true. Okay, so hold on. So in that worst 6 month period, in that sell may go away period, which months tend to be on a comparative basis the strongest for those that believe in the seasonality side?
The strongest of the worst.
Strongest of the worst. So in terms of the months,
July, and October is now the bear killer turnaround month. So July, the first month of the second half, the first month of the third quarter, has shown strength across the board. It's also a nice time to get out of those those tech positions for the August September drop that we see. It's hard for people to not buy stuff all the time. I mean, it's okay to cash gives you time to think. We can get interest now just sitting around. So I'm all right waiting around a few months and then getting long in August, September, October again.
I had Darius Dale on one of these spaces, and he was joking about people losing their damn minds if they couldn't buy Apple, right? Because it just goes sideways. And so to your point, it's hard for people to understand that they don't have to always trade. Now, for discretionary traders, nothing says you've got to try to go long or short here.
So, I mean, the benefit of the calendar and the way we have built our strategy is there's usually something to buy or sell or trade. I mean, there's bond positions right now. There's utilities. There's healthcare. There's staples. We're looking for our buy limit, our buy point that we pick looking at the charts. We also put out, a gold and gold miners and silver trade. We're waiting for him to come back a little bit. It's not a real seasonal trade, but it's kind of, a strength begetting strength, as well as, the headwinds and the safety here. So we're looking to get into the GLD and the SLV and the GDX on a little bit of weakness. We say buy dips. We got a couple buy limits in there. So there's plenty of things for us to get into, but I'm not just waiting for the banks to, I'm not one of those types of people that's looking to short all the high flyers and buy all the dogs. We use a nice mix of seasonals and fundamentals and technicals, and it seems to work over the long haul and even in the short term. So we stick with that.
What about the currency side? I mean, I'm of the mindset that the dollar probably is going to have a surprise move higher. That's consistent with risk off. And just like you had everybody talk about the dollar wrecking ball at the peak, right now everyone seemingly is bearish on the dollar. I don't think it's inconsistent to think that the dollar could rise and gold rise at the same time. But any kind of interesting analysis there?
I mean, I don't really do currencies like that, but the dollar could easily get stronger, especially as the U.S. economy firms up here with the Fed having done its duty. Kind of late by my assessment and too long by my assessment, but I'm not an economist. And I think that sets up nicely for the dollar to regain strength. Everyone's all worried about China taking over the world and what's going on elsewhere, but we continue to have a very robust system here. It's as fair as they come. I know there's corruption everywhere, but I think the dollar could easily strengthen and continue to gold can continue to be a place to be as well. I think we're looking at like a long-term stock pickers market, perhaps something more along the lines of the I don't think we're getting into a secular bear yet, not for a couple of years, but perhaps some stock picking times of yesteryear where you got to find good stocks at the right time and use your strategies, and the seasonals are in play. So I think the dollar's bound to get stronger.
Just to reset the room for the remaining minutes here, everybody please make sure you follow Jeffrey Hirsch. And if you don't already have it, I highly, highly, highly encourage each of you to check out Stock Trader's Almanac. It's always been one of my favorite books to refer to. If any of you want to come up and ask questions, click that bottom left mic request button. I had asked a question via DM to me. Jeff asked you, she said, will you please ask him about 1995, 96, just because that was after Greenspan's tightening and everything that happened with bonds in 94, 3-month treasuries during that time. Any parallels at all to that part of the cycle?
I mean, I don't see any real parallels here. I know Greenspan had started doing some things there, but those were the years where it was kind of just straight up. I mean, that was the end of the last super boom with all of the technology kicking in there. I mean, every year was up in the 4-year cycle. It just kept going, all the way through there. It was the end of the millennium. So I find it hard to draw comparisons to that period of time. There was something I wanted to bring up that I just remembered about the Fed and the bond market, which now that you mentioned Greenspan, it reminded me. We went back and looked at minutes from the old days when Volcker was in there, tightening up and clearing out the inflation back in the late 70s and 80s there. And I know it's I'm not a this time is different kind of person, but what's similar to me, or excuse me, different to us now is that you could hear from the minutes that they were listening to what the bond market was doing and reacting like, oh, the New York desk needs this and this and this. And the windows, the range of the interest rates was like 5 percentage points. Like some if it goes past the 15 to 21% range, then we'll make an adjustment. And they were listening to the bond market, the people who really know what's going on out there. And nowadays, the Fed is trying to lead. And this is why I think the yield curve may be lagging the recession, and things may be a bit inverted this time around because of the Fed's maneuvering ahead of the bond market instead of listening to it, which is the way it used to be. And that's all of the historical data on the yield curve and all that stuff is based upon years gone past where the Fed was following the bond market instead of trying to lead it as it is now.
What do you think are the implications there? So I've made that point before. It's like the Fed doesn't own the bond market owns the Fed, which is another way of saying what you just said, right? But
yeah.
So and it seems to me like every time you have a headline that it's the most inverted ever, it gets more inverted, right? You think the Fed is maybe getting a little bit too cocky in thinking that it can control this?
Yeah, I think they already have. It's way far gone, way past getting. I mean, they're trying to. I mean, not that it's not a valiant effort. They're trying to do the right thing. They're trying to learn from the past, but a bit much. So, if you want to hear this quote, I just found it from the August 18th, 1981 meeting, just before the historic yield curve inversion in 81 that everyone was citing back in March. This is in quotes. The chairman may call for committee consultation if it appears to the manager for domestic operations that pursuit of the monetary objectives and relative reserve paths during the period before the next meeting is likely to be associated with a federal funds rate persistently outside a range of 15 to 21%. Oh, I'm sorry. And we're worried about 5%, 0 to 5 here.
Yeah, of course. I mean, back then you didn't have $32 trillion of government debt.
I understand. But there they were just off the desk, their objectives are not right. We'll make an adjustment by the next meeting. Now it's like, this is what we're doing. We're data dependent,
I think that's the issue, right? The issue is they have to be so much more precise now than in the past, because when you're in a highly levered society, right, it's classic butterfly effect argument, right? Small impact having against high leverage creates margin calls. Right? It's like I made that argument before. It's like, okay, so it's true. There's a lot of cash on the sidelines. A lot of money's gone into money markets. Shouldn't that again keep a floor under equities? And my response is, okay, but if you have a margin call because the system's levered, a lot of that money goes away, right, to cover existing leverage. So the Fed of old versus the Fed today, could have been, you can argue, a little bit more random in its interest rate policy versus now where it has to be really precise.
I think that goes, with a lot of things this day and age, that everything's got to be more precise, especially your words, everything's recorded, But yes, the amount of money is definitely exponentially larger, and things change up, much faster with each BIP. Yeah, so I don't know. I'm just not convinced that the world's ending here, that we haven't seen a lot of the negativity over the last, 6 months or more, maybe even better part of last year, where this sort of rolling recession and rolling bottom. I mean, the Russell that everyone's worried about right now, which, is struggling with some of the banking issues and some of the other small cap stuff. It bottomed back in June on a closing basis. Dow bottomed in September on a closing basis. S&P was October 12th closing. NASDAQ and the NDX was December 28th closing, but they all had an intraday low on October 13th. We've seen, lots of layoffs from big companies, resetting from their pandemic, big hirings, and there have been a lot of, earnings revisions and not as bad as expected stuff. And some things there's just, I'm sorry, everything's just not going in the same direction. And it's creating this sideways action, this probably correction, but I don't see the lows being taken out. I don't see, the end of the world, this Armageddon bear market that, the fear mongers are calling for. We could easily churn and have different things rotate into leading and lagging as we work through the excesses from, the Great Recession, ZERP policy, and the pandemic fiscal spending, and the political and sociological upheaval we've had over the past couple of years. It's going to take it's going to take a while for all that to heal and work itself out. And the stock market is the best indicator of it all, as far as I know.
So I saw you were liking the tweets to the response to the space where I said reread the tweet, right? The people that were commenting on it.
Yeah.
So base case, 10, 15%. What would cause you to say, you know what, now it's a different playbook? Maybe the base case was wrong and there's a new base case. What would you be looking for to change the mindset there?
Well, it wouldn't be a new base case. It would be our worst case scenario or our best case scenario or somewhere in there. So back when we hit the January indicator trifecta with the Santa Claus rally, the real Santa Claus rally, the last 5 days of the year and the first 2 of the new year that Yale invented, and the January barometer, full month S&P January, and then the first 5 days, all those 3 were up. We had a bear market. I argue a bottom back in 2022. It was definitely a bear market in everybody's book. Whether it was over or not, that can be debated. That's when we flipped to our best case scenario. We were looking for, above average pre-election year gains of more like 15 to 20%. And in order for me to see that again here, I think we need to take out those August highs, about 4,300. We'll need to see breadth improve, small caps improve, and other things along those lines, new highs, new lows, all that kind of market internal stuff, which we haven't discussed yet. And on the flip side, we'll need to take out those lows. We'll need to take out 38 with 3,800 with, some bad breath and some other things. It could also be some exogenous impacts either positively or negatively, whether the war in Ukraine ends or gets worse, something happens in Washington, where the debt ceiling gets solved, or there's a real huge impasse. I mean, it's any number of things could trigger that, but I think we'll all see it in the charts. And again, you got to draw those lines with a big, fat, thick crayon or Sharpie, because it's not an exact point of 3,800 or not. It's relative with other things going on. And that's why, everyone's been trying to design the best algorithm ever, and it still doesn't exist. And it takes the heart of a trader and a manager to be defensive, hedge themselves, and make smart moves when the time comes.
I love drawing those squiggly lines with crayons, as some Twitter followers may be aware of. Okay, so you got the Commodity Traders Almanac coming out soon.
Mm-hmm.
Any interesting things that you've uncovered when it comes to different commodities into an election year? Forget about the pre-election year. Let's kind of go beyond that. Commodities are still a hot area in terms of where people want to focus. Right, it's been maybe disappointing, other than gold, especially this year, right? But what interesting observations have been coming out from that work?
It's more a seasonal thing. There's not a whole lot of 4-year cycle stuff. I mean, commodities revolve around the calendar with usage. I mean, it comes out of the agricultural, sort of mindset and the heating and cooling mindset. I don't see a lot of real 4-year cycle correlation with commodities. It's more, business cycle, which is not really, as cyclical as I look for. But some of the things that we've seen with other with the stock market seasonality, some things have shifted. I mean, I just put out a little chart on the spec list that I'm on there, and Larry Williams reminded us all that it used to be buy in May and make some hay back in the old days. And I have a chart, I think you've seen it, where the Dow goes up from May through September, when with the planting and harvest, the reaping and sowing season. So we've seen some things shift like that, as we have with the stocks. Oil, energy has gotten weaker, or the bullish period has ended a little bit earlier, like in May. We've seen gold shifting. So it's kind of a tracking of how our collective behavior as investors and traders has impacted some of these patterns. But I don't really see anything 4-year cycle oriented or commodities that are hot coming into the election year. I think it more depends upon, which president and which policies are coming in, as to what commodities are going to be, whether it's the climate change people, or the build back better. I mean, that's the same group right now, or whether it's, infrastructure and, some more of the materials and copper and that sort of stuff. But I think that's more depending upon the policies and the administration that's coming in.
Are there any particularly strong monthly patterns with certain commodities that tend to repeat? Yeah, I mean, I know obviously with sell May you go into bonds, right? So that's clear, right? But what about on?
That's a good one. That works. Some of the faves, copper in December, along with oil and oil stocks, which is sort of commodity related, and the natural gas trade in February, which I got into myself, seems to still be a nice strong period. Gold in the fourth quarter works. It's hard to really get a great trade on if you're not a real commodity trader with grains and some of the other ones like hogs. Or there used to be a nice trade for cattle. It sort of revolved around the summer build up for all the school lunches, where you'd see this run in cattle starting in early summer going through. So it's a little more nuanced and a little more complex than your sell in May or your buy in October and your best and worst months, because there are different growing and usage periods for the different commodities. So, you'll have to read the book to see all the tricks and secrets.
I love the tease there.
That's a big long-term chart. That reminds me more of the super boom forecast I made. The downtrend in rates, it's, as Michael was pointing out, it's hard to envision us going much higher with the amount of money. What's the word? Just floating around or sloshing around is the better word. But I think we've seen a low. I think the end of the zero interest rate policy is here. I just don't think we're going to get back up to any of those high levels that we had in the past. I don't think we can afford it. But 5% is historically, at low average for that type of thing, and it seems more reasonable. I mean, I think we're going to have to get used to not having these super low interest rates. I'm sorry for everyone who didn't refinance during the those low rate periods, but that's going to be the reality. So yeah, I guess short answer is yes. I think that 40-year downtrend is over. I just don't think it's going back up to those double digit or high single digit levels. I can't conceive that being manageable or affordable with the world and the coffers and the balance sheets that the size that they are. I mentioned this big forecast. I don't know if you and it sort of dovetails with what you're saying about what happened back in the 60s and the Nifty 50. So I'll tell a story. Back in 1976, my father put out a forecast for Dow 3420 by 1990. And he did a whole study on, and this is a cycle on 500% moves in inflation, 500% moves following inflation, and the secular bear market. It's basically and war. It's based upon what happened after World War I and World War II. And the forecast was we're at the end of Vietnam and the inflation ending, we were going to rocket up 500+ % points. We did. Obviously, there was that August 82 bottom. And then, the inverse of that, the post-World War, or the previous one, the post-World War II super boom ended it with the Nifty 50 there. We had that whole secular bear market from, you could argue, 64 with the Gulf of Tonkin resolution or 73, whatever you want to put it there, all the way through 82. So I put out a forecast in 2010, May of 2010, with the Dow around 10,000 for another 500+% move for Dow 38,820 by the year 2025. So we're pretty close to that. And, I have a projection chart that sort of I put out with the book I did there. And I've been thinking, like, what am I going to do for an encore here? And talking with some hedge fund friends and trader friends who are stock pickers, it's looking to me like, and this, maybe a little, you heard it here first kind of thing, that once we get up towards those levels, we might go a bit higher up to the 40,000 area, in the next several years. But we may end up going back to that 70s sideways period where, the stock market doesn't go a whole lot of anywhere for the better part of a decade or so, or at least, it could be a shorter time frame like we had in the 20s where it was like, less than a decade, some of those, that secular cycle. So I don't think we're there yet, based upon the long-term cycles that I'm looking at. But there is a potential for us to have the stock market not do a whole lot with seasonals and stock picking and, old-fashioned, technical and fundamental analysis paying off for quite a number of years after the next election or so.
I would add real quick on that. I would add, that shouldn't be that surprising to people. I mean, I keep making this point. We've had more than a lost decade in emerging markets. You had effectively a lost decade in certain parts of the bond market with the sell-off last year. I mean, why is it so impossible to imagine that we're already in a lost decade now for U.S. equities?
That's not unimaginable. I just don't think we're there yet. I think, and if anyone's got an almanac, a 23 almanac, this is all updated on page 104.
I'm looking it up. No, I'm not. I was going to try and reference it real.
You have an almanac, right, Michael?
I'm telling you, I'm not. There's no bullshit to the audience. Like I have always been a fan of the almanac. So to me, it's like I say, it's a phenomenal study.
But this big chart that is a redraw of what Yale did back in the 70s. I mean, in the book that I did, I have a picture of the newsletter that he did, where he drew the lines with a marker on a transparency thing that he used to bring out. And you'll see what you're talking about in the 60s on this, where we went sideways. Yeah. I'm with you on that. You talk about rolling inflation. I reference, some things you see on Main Street. I just picked up a couple of grilled chicken breasts for lunch. That used to be $9.99 a pound. Now it's $12.99 a pound. mean, that's some nice inflation right there.
What page of that is that on in the almanac?
104, 104.
Okay. And I'm talking about the price of chicken.
Oh, the price of chicken? It's iron tomato in White Plains, but it's still good. And you saw the eggs go up and then they came back down. I mean, I see the rolling inflation, and I think the impact on Main Street. People who run stores and who whether you're a national company that's putting out things into grocery stores or wherever, or you're a small shop, sometimes it takes a while for you to raise your prices. Because you don't want to lose customers. And I think that's definitely happening. I'm still seeing the upside for at least another couple of years, but it doesn't mean we haven't seen the top already. I personally don't believe that. My research doesn't show that, but I think we get through another election cycle before we get into the potential lost decade in the U.S. with working to bring manufacturing back here and moving stuff from China to Mexico, which is happening, as you astutely point out there. I think that's going to take some time to work through, but it is. We are starting to see that writing on the wall, though, for sure.
Maybe just to close off, I want to get your thoughts, speaking about commodities, on if there's any interesting patterns when it comes to my favorite commodity, which is lumber. I keep back to, and a lot of people have noted this, home builder stocks are giving a very different message than lumber itself. I have not myself seen any evidence that suggests home builder stocks are predictive. I'm happy to be proven wrong on that, but I know lumber historically can be. Any interesting kind of seasonal patterns or anything that you've noted when it comes to lumber, when it comes to that commodity traders almanac?
Guess what's not in the commodity traders
almanac? You're killing
almanac?
Me, man.
But guess what? We still have time to put in there.
Okay, so you want me to write a forward around that? I can.
Yeah, maybe you'll help us do the research on it.
It's funny because lumber. You actually prove exactly my point. It's like nobody focuses on lumber, but I'd argue again, it's the most important commodity because of the link to housing.
Let's do this offline. We will consider putting, if we can find some proper cycles and almanac style stuff for lumber, and it works, and we have a highly correlated ETF for stocks to trade it, like the home builders and such that you're keen on, that you're versed in. It would make a great addition to the Commodity Traders Almanac. And who better to be involved than you?
Everyone heard it here first. I am now going to be a part of it. All right, maybe for the final few minutes again, everybody, please make sure you follow Jeffrey Hirsch here on Twitter and check out Stock Traders Almanac and Commodity Traders Almanac. If you're a let's call it a retail investor trader, your best piece of advice in this period would be what? It's not about buying or selling, but what would be something that you think people need to just keep in mind for the rest of the year?
Patience, remain calm. You don't have to buy. You can sit in cash until you get a fatter pitch, till you get a better, entry point, a better opportunity. I mean, if you're a nimble, savvy trader and you can move in and out, have at it, use your strategies. And I just want everyone to know that we do a monthly webinar for members only, and we spend the bulk of the time answering questions and talking about stuff and getting ideas like I just got from you and the CDS thing. People will bring up things and ask us, like, well, how do you trade this? It's like, well, I mean, here's our trading strategy. When you go to take a position in a stock or an ETF or whatever it is, you become a day trader, even if you're not, the day that you're going in and making your trade or you're looking for your buy limit. So, I mean, I think patience, calmness, check your emotions, now's the time to clean out underperformers and losers, go easy on new buying, and just tighten up stops and be a little bit more defensive and neutral, especially with all of the headwinds and obstacles we're talking about, not just the seasonals, but the other topics we touched on.
That's a good place to wrap this Twitter space up. Thank you everybody for joining, and hopefully I'll see you all next time. Thank you, Jeff. Appreciate it.